between two companies, two junior companies developing projects where there's synergies. So that's just a couple of things that, if you're looking at early stage investing or junior companies, that are critical.
I'll add something to that. And everything Nick said is obviously spot on, but I'll distill it into one concept. It all starts and ends with the resource reserve, because if you don't have that, you don't have anything. So certainly for assessing construction risk scenarios on single assets, in my mind, that's what it's all about. If you don't have a reserve or resource, you don't have anything.
Thanks, Charles. I guess what about, we're here to talk about gold. What about different commodities, in the sense of, is there anything particular or specific to gold that we look for, would we say, compared to other commodities? Maybe Campbell or?
Oh, sorry.
John, sorry to put you on the spot.
Talk about gold.
Yeah.
Look, we have the benefit of being private, very private. So I agree with everything that's been said, but we probably have a couple of different views on a lot of that sort of stuff. For example, we often look at projects that have a very limited lifespan. You might have 18 months, because they've never been more profitable. Because the first thing that's done is the sustaining growth capital's cut out. They've made more money in the last 2 years than they've ever made in their life. And that's great. You're in for a close down and a bond and all that sort of stuff. But we focus specifically pretty much on precious metals, but we look anywhere, look at anything. We've done iron ore. Coal's a bit difficult, but you can get in and make a lot of money, but you can't get out. So we have, I guess, a benefit being private, in that, one of our operations, we feed 30% uncategorised ore. We don't even have any measured in it. We have no reserve, and we've got about 30 years mine life left, we think, maybe 50. And that doesn't bother us, because we know the ore body very well. We've got a great team. We've got a reasonable balance sheet that can keep that thing going. And we're now in expansion mode on that one. We're looking to pick up strategic opportunities around that as well. So a bit of a mixed bag of an answer, but anyway.
Okay, thanks, Campbell. What about tier ones as opposed to juniors? Again, when we talk about looking for projects and looking for, what we look for and what we want to see, is it different when we look at a tier one versus a junior?
I think, Rubens, it's very much the case when you're dealing with commodities other than precious metals, other than gold. The great thing about gold is that you can build a project in deepest, darkest Africa which has no real infrastructure. It's great if it's close to infrastructure and power in particular. But you can build a project in deepest, darkest Africa, and you can fly your doré bars out, and they'll fly to a refinery and they can be refined. If you're dealing with a lot of the tier one projects, particularly in bulks, so iron ore, thermal or metallurgical coal, infrastructure is critical. You have to be near a port and near a rail line, generally speaking. I mean, John Wellborn's proving that theory wrong, with his logistics project at Felix, which
Phoenix.
is
Phoenix.
Sorry, Phoenix, sorry. Thank you, Charles. But generally speaking, the great thing for the investors out there, the mums and dads, a project can be built in deepest, darkest Africa, particularly when it's got a great grade.
Thanks, Nick.
Is that before you get your $30 billion tax bill from the government? Which you have to pay, or give me 50% of your...
And your royalties.
Yeah, but they wait till you spend at least $300 million, and then bang.
Reuben, if I can just pick up from what Campbell and Nick have
Sure.
both said, the great thing, gold is different to all the other commodities, and it's easier. Everything about the gold mining business is easier than any other aspect of the mining business. It's easier to finance them. The metallurgy is typically simple. You ship your gold bar out in an aeroplane. You don't need any of those other things. If you want to build a gold business, so from an M&A perspective, the universe of opportunities is just so much larger than any other commodity. So everything about the gold business is easier than every other commodity that I'm aware of.
Thanks, John.
Yeah, including to the fact that it's fungible. You produce a bar of gold and you can deliver it to, once it's refined and it's London good delivery bars, then you basically get your money, as opposed to some of the other commodities where you need an off-take market, where you need certain specifications in your iron ore, or particularly in your coal, that an off-taker will want. And that's creates all sorts of challenges for those sort of operations.
You don't need a marketing department.
Absolutely.
And further, from a funding perspective, banks, which is part of the one pool of capital in terms of funding new projects, it's very much down the middle of the fairway in terms of their ability to fund gold projects. As you expand into other commodities, which as the gentleman referred to, it becomes harder for banks to fund. But certainly gold is right in the middle of the fairway in terms of banks' ability to fund and build new projects, simply because we know the technology. Banks have been doing it for many, many years, and it's very well understood.
Just with a little comment in relation to the bank's funding, and particularly your debt funding, Charles. They will require the hedging for their risk committee to basically approve the project, and of course there's some nice income in hedging. But the good thing about the gold market, generally speaking, is it's a contango market. So when you hedge forward, typically you'll get a higher price than the spot price. So as opposed to some base metals, if you're going to do some hedging, it might be a backwardated market. So that's another positive of gold when interest rates are where they are at the moment. Back when I bought my first house in the late 80s, you might recall interest rates were 17, 18%. The contango market was phenomenal back then. You could sell, let's say the gold price might have been $300 US, you could sell 5 years forward for probably about 550. So the fact that it's a contango market is in favour for the producers as well.
You've certainly headed down a wormhole in talking about hedging. The great Sean Russo is in the audience, and he will certainly be able to offer the audience a view. I notice there are some great, we've failed to mention, we've got Hedley Widdop, we've got Keith Good, we've got Aaron Collar, and guys have been in the market for many years who are very familiar with what we're talking about up here. Back to you, Reuben.
Thanks, Charles. So I guess from a attracting investment perspective, but mining companies, but particularly gold companies, how do you see that right now? Is it hard for companies to attract investment in the general context of mining companies and, you know, the perception of industry and so on? How do we feel about companies being able to attract the investment they need? Well, John, I see you smiling.
Yeah, let me start.
Throw your thoughts in.
In the next session, we've got the two Simons presenting, Simon Lawson and Simon Lill. Between them, those two companies have raised more than $1 billion of equity in the last 12 months. I think that says all you need to say on the subject. If you have a good project, you can attract equity.
Very good. Any other thoughts on that?
Totally agree.
The difficulty for juniors at the moment, and for the last 2 years, it's been a very, very tough space for juniors, and I'm sure many of the mums and dads here who have a portfolio of junior, maybe gold stocks. It's, as Grady again said in the previous presentation, management have got to really manage their equity funds that they raise carefully. The money has to go into exploration. As Charles said, it's all about your resource and then hopefully converting that into a reserve, which is an economically mineable mineralisation. But managing that money and make sure that you're getting your bang from your buck from your drill piece is really critical. But you know, in the last couple of years, as I said, market capitalisations in junior companies has been falling. It's harder to get interest from institutional and you know, mum and dad shareholders. They keep on coming back to the well for another raising, you know, every sort of 6 to 12 months. And it's been a really tough environment for the juniors. I think there will be a lot of consolidation in the next sort of 12 to 24 months in that junior space, trying to find synergies, trying to get, you know, a company that's got projects that, you know, the market has confidence can be developed, you know, but it's about proving up that resources, which is the really critical thing.
Thanks, Nick. Okay, so in terms of entry and exit points when we talk about investment, what are some of the typical entry and exit points you guys look at, and some of the, I guess, what's that dependent on? You know, it might be commodity, it might be, you know, again, the particular project. Campbell, if we're going to get your thoughts on that one?
Well, we are happy at any point. We've always often specialised in broken companies, you know, that are truly broken. And generally, when you look at it, you know, it's again the quality of the ore body. We tend to note that about 95% of the problems of why it's broken are at the corporate level. for a start. May not well be at the ore body level or the operational level. And so that's easy to fix. You can fix that sort of stuff. So it depends for us on, we can be in and out fairly quickly, or we can take an evergreen approach and do it for 10 years. It just depends on what our investor syndicates are looking for. So again, it's matching to what was mentioned before. And just to add a couple of those points on debt and easy. I mean, every other mining must be bloody difficult because gold mining ain't easy, I can tell you. And debt, Australian banks generally will only look at the top tier projects or companies. Juniors, mid-tiers are not going to get looked at. For example, the typical comeback, even from someone like a Macquarie who's quite good in this space, will be, we want a 7-year mine life and a 3-year runoff. We want it fully hedged and all that sort of stuff. Well, we see what happened to Beaconsfield, right, in those last 6 years as a result of that. But, the costs for a mining operation to get a 10-year reserve would outweigh the amount of debt that they're prepared to lend against it. So, that's got to be equity. So a lot of these junior mid-tier guys have got to be equity. And if you can be in a luxurious position where you can have a large hole in the ground with good grades, then you might get it. But I'm only talking from underground high grade because that's what we love. Because we could say anyone can dig a hole in the ground. Not many can go under.
Thanks, Campbell. Any other thoughts on entry and exit points?
Like Campbell says, really interesting, like special situation scenarios where exactly where via their expertise they identify an opportunity and are able to quantify that, and hence that's I assume your mode of attack.
Yeah, absolutely.
Really interesting.
From the Taurus perspective, our main fund is a credit fund or a debt fund, so project finance, acquisition finance. Before our technical guys, so we've got a team of sort of half the team are originators, deal execution, and half the team have got a technical background, geologists, engineers, maybe metallurgists. Before we can get our technical guys interested in reviewing a project, the deep dive into the data room and reviewing all the resources, reserves work, the metallurgical work, the offtake agreements, we have to have a fairly high level that there will be a project in this. It might be, sort of 2, 3, 4 years down the track, but we have to have a high level of confidence that this will become a project before we spend a lot of time reviewing that technical work. We have a number of examples of doing what we call a bridge facility. So we have a high level of confidence that as a company is waiting for their permitting or they're completing optimisation work to go from a pre-feasibility study to a definitive feasibility or bankable feasibility study, that we form a very strong view that this won't be a bridge to nowhere, as we call it, that this will become a project. And so it might be, for example, a $20 million bridge that allows the company not to have to go into the equity market and, with a dilutive raise, but the bridge would be tied to maybe $150 million project finance. There'll be a whole bunch of what we call conditions precedent to draw down of the project finance, but the first drawdown will repay the bridge. So that's a solution that, as the guys said, if it's a great project, the banks are all over it and we won't compete. We're not the cheapest money, going around in the mining industry, but we'll struggle to compete. So we have to come up with these types of solutions to get mandated to take projects forward. And we also recently raised a royalty fund. So that's another option for junior miners in particular to source some funding outside of an equity raise. And basically we would like about 50% of the royalties that we purchase to be producing royalties, but we're happy to look at buying royalties where we have a level of confidence that good management coupled with, we think that there's a lot of exploration upside and we think that this will go into production within say 2 to 4 years.
Okay. Thanks, Nick. When it comes to companies and financing, I guess we typically see debt before equity. I guess is this optimal? And is there a different way companies should be possibly going about it? I guess, John, I might throw this one to yourself.
Let me start with an example. a company I was involved in some time ago. When I arrived, they had this wonderful debt facility in place, not just in place, but signed up and paying commitment fees at a couple of % a year.
Why are you looking at me?
No, nothing to do with you, Charlie. They hadn't worked out where to get the equity from. People like Charlie and Nick, there will always be an amount of debt which is available to a decent project. Depending on the commodity, and gold is typically going to be easier, but the equity bit is always the hardest. So junior companies tend to go out and chase the debt bit first because it's easy and they can show some runs on the board. They actually should be starting at the other end, working out whether they can attract equity to that project and then go and get the debt.
One interesting comment to that is that if a bank is looking at a single asset construction risk scenario, the amount of work, the diligence that it has to go through is significant. It involves essentially auditing the bankable feasibility study, bringing in independent technical experts, and essentially adjusting the financial model to the extent that the independent technical expert advises you to do so. Off the back of that financial model, the debt carrying capacity is then determined by the banks. It may or may not have hedging, but that's a separate issue, as I alluded to before. What that does, it's an extremely painful, it's a rigorous process, but what it does is if you are, and it's a really interesting comment by John, if you are able to demonstrate to the market that you have got project finance from a bank, what you are saying to the market is that you are giving that project a big tick, simply by virtue of the rigorous nature of the diligence that has to be done. However, typically when banks do that, one condition precedent, as Nick alluded to funding, is the equity raise. So the way I see it, it certainly goes, equity and debt go hand in hand for the most part, and having your equity fixed up before your debt is a tremendous advantage.
And just quickly on that, typically the debt to equity is 50-50 or 60% debt, the total capex, the capital build spend for the project and the commissioning of the project. It could be as high as 70% in the gold market, because with the banks, if they can hedge a good portion of the production, then when you do your financial modelling, and Chris and Reuben's, you guys mentioned that you will build the model for the client as part of the scope of work that you guys at Ausenco do. But when you do your modelling, we, for example, will put in a price that typically, spot gold now, 2,525, we'd probably put in 2,100. So you always look from a lending perspective at what happens if the price goes down. But if you've got a whole bunch of hedging and you've locked that away for, let's say, 50% of first couple of years of production, you can increase that debt carrying capacity maybe to 70%. Makes the company, if they've got a single project company, as Charles mentioned, it allows the company to get away with a reduction in the equity raise. So gold, again, is a great commodity because of that hedgeability of the product.
Thanks, Nick. Okay, so I guess private debt markets. So we're now seeing that as a real option for gold miners. How is this different to typical construction financing? I guess, Charles, probably your bag.
Yeah, well, just as background, I've been in the banking markets for quite a while, predominantly in commodities for many years. And in the last 18 months, I've moved into the private debt markets at Commonwealth Bank of Australia. It's a really interesting question. If you think about it in pools of capital, the private credit markets, every day in the Financial Review, there's an article about private credit markets. And I'll make a couple of comments about it. One, it's a significant pool of capital. On a global basis, it's anywhere between 2 to 3 trillion US dollars. It is huge. In terms of, in Australia, I think Ernst & Young estimated that pool of capital at around about $200 billion at the moment within Australia. And that will continue to grow. So there's a couple of characteristics about that pool of capital. One is that it is large, and secondly, it is short assets. Now, if you refine it further, distill it further, within that significant pool of capital, there is appetite for mining risk, operating risk. And I think everyone has seen that in the last couple of years with private credit funds coming in and funding coal companies as banks have moved away from funding coal. But by virtue of the weight of money, there is absolutely a pool of capital that I've seen, and in fact the market sees, that sits within that private, the larger pool of capital, and I'll call that operating risk capital because it's very comfortable with operating mines. In terms of funding for new projects or gold companies, for new projects specifically, that's what I would call construction risk pool of capital. That's typically been the domain of banks and also bespoke private credit funds such as NICs who have an in-house technical capability to understand risk, and Nick talked about that. So the point is, with this pool of capital that's for operating risk versus this pool of capital that is somewhat impacted by banks' risk appetites diminishing, it's my view that there will be leakage and there will be more money that needs to come in from this pool of capital into that pool of capital over time. Obviously, a fundamental point, again, is, and I won't call it a barrier to entry, but having the in-house technical capability to assess credit risk on the mining assets is obviously critical for that pool of capital if they want to go into this pool of capital, if that makes sense.
Thanks, Charles. Any further thoughts on that from the panel? No? So, okay, well, maybe we'll switch over to a bit more sort of technical side of things. So I guess, we've talked about the ore body and the importance of what's in the actual ground. From that perspective, what do we actually look for when we have a look at an ore body or, the results that these companies are putting out? Maybe, Chris, if you want to throw in from a project delivery perspective and also, the viability of a project, what do we look for when it comes to an ore body?
Yeah, I've been rather quiet, letting the finance guys biff it out. But no, from the project delivery perspective, I mean, everything that Grady said, it's been said multiple times over the last day and a bit, is all part of the fundamentals. The grade, the ore body, how easy it is to access. There's a couple of things that are a bit different about gold, and like you said, Nick, at the end of a gold plant, you walk away with a gold bar. And yet you can build a plant in deepest, darkest Africa. It's a bit harder to build, so we've got to consider that element of it. But there's also a security aspect to that, and how you're going to keep that plant secure through the life. There's elements such as you use cyanide to process this. It's obviously not the best reagent chemical to be releasing into the environment. So there's environmental concerns that traditionally other commodities wouldn't have. But you do have the benefit of things like you got a gold bar at the end. You can use technologies like gravity separation to improve the throughput of your plant and the grades that you're recovering. On top of that, we also, we want to look at the work that's been done to date and look at it critically to see where the gaps are and in particular where Ausenco can move the needle and improve things like CapEx, OpEx. Look at different technologies that maybe haven't been considered, different approaches to things like tailings, access to water and power, and how we can maybe reduce our water footprint, power footprint, the ESG and the social aspect of it. And key, we've spoken about team and the client's team before. Have they done it before? Have they built a plant before? Have they done it in this commodity before? And that's all important. But Ausenco in particular, and Reuben said it earlier, our motto being find a better way. It's in our DNA to challenge our clients and to really push them to think outside the box. And that's not the right approach for every team. So when we're evaluating a project, we're often looking at how will we work with the team on the other side, and will they be open to innovative approaches, or are they bringing a lot of baggage that maybe they're stuck with certain ideas and certain technologies and won't want to stray from that. So these are all things that we look at from the project delivery side that, I would say other consultants necessarily don't see it the same way, but it's certainly things that at Ausenco we certainly look at when we're evaluating a project.
Yeah, thanks, Chris. I guess you've talked about
Can I ask Chris a quick question? I mean, one of the things that's important when our technical guys start to do the deep dive into the study work that's been done, the pre-feas or the bankable feasibility study, across all the ranges of resources, environmental, permitting, metallurgy. But as a non-technical person, Chris, my technical blokes will often really take a deep dive on who has actually done some independent work for the client, and what is the reputation of that independent group in the markets, and what has their track record been like in relation to the work that they've done. You guys, when you get mandated, do you obviously sometimes go to your client, we're not that happy with whoever's done the independent work?
Yes. Often it comes in around test work. Mining methods, sometimes we question the mining methods. A lot of people look at the mining and the process plant as separate pieces, but you can't do that. What's coming out of the mine has to go to a process plant, and if you're mining at a particular rate or a particular part of the ore body, a particular grade of the ore body, that might make sense economically for the mine, but it might not make sense economically for the process plant. And so you need to, assess a few different scenarios there. Not everyone does that, and so we'll often question the mine plan in that sense. We'll often question the test work that's been done. Is it the right test work? The core samples that were taken, were they the right ones to do the test work on? So yeah, we'll often pick up a previous study and identify the gaps, do a bit of a gap analysis, and that's part of our sort of offering and how to move the project forward. And we like picking up projects where we feel we can move the dial in that sense.
And if it's an underground mine, making sure that the mining process is such that you can keep the plant full. That's a major problem for underground mines, as we've found out a few times, that the development work, particularly around the commissioning stage, is not as far advanced that they just struggle to keep the plant full, and therefore your all-in sustaining costs go up. I don't think Kerry, many people here know what you guys do, the wonderful job that AMEC do in the industry. So why don't you give us a quick summary of what AMEC does, because you do a fantastic job.
Thank you. Thanks, Nick. So AMEC represents over 550 Australian companies, including explorers, producers, suppliers, and other ancillary services into the industry. And what we do is advocate for the industry to the government to get laws changed. We have lots of input into legislation. And for example, in New South Wales, where I'm working, we have regular meeting with the resources regulator where we can suggest and very quickly obtain improvements to systems. So we're very agile. You would, obviously everyone knows about Regis Resources. Our advocacy on that, because they are one of our members, was to let every Australian know the facts and the details of the case and really beat the drum and get that information out there. And I think we've done a great job of that. We were on the news again last night. And so we'll have to wait and see what Regis decide to do in relation to their next steps. But we've certainly raised a lot of awareness about how that could impact the industry, how negatively that could impact the industry. And I think that advocacy has been quite successful. However, even in the recent budget, AMEC was successful in getting up a $7 billion production tax incentive for the industry that would kick in 2027 for some critical mineral projects. So we have a huge impact on the industry. And we really do support the juniors. We are the advocacy industry for the juniors.
Were you guys involved with the Bowden Silver Project, silver mines as well? That was the project near Mudgee. I'm sure many people have just heard about what happened there. You guys involved there?
They're not one of our members. However, I'm sure that they will reapply and be successful. And we're about to have lunch with the New South Wales Mining Minister, and they are coming along to talk about their concerns and issues.
Nick, what happened there? Sorry, just remind me what happened, please.
There was, I think it was at federal level, wasn't it? I mean, it got state approvals and what have you, but then there was an appeal to the Court of Appeal, which upheld the applicant's view. And I think it was in relation to 13 kilometres of transmission lines,
Yep.
which swayed the Court of Appeal to find in favour of the appellant.
So one of the big problems is duplication of the application process. So we've spoken a lot about how long it takes a project to get approval and permitting, and can be up to 16 years internationally. It's a very, very long lead time. To be honest, the world needs the outputs from mining. There is no other source of these minerals, and it has to come from mining, so we have to get these projects approved. And so we really advocate to make sure there's not duplications, as we just saw in the Regis case, where, for example, in New South Wales there was a 7-year process. The state government approved the project, and it went to the feds and it got rejected. So after 7 long years of the process, that duplication of legislation, I guess, is really what's causing our problem.
So Kerry, I guess Regis is a very current and current example.
He's also, the CEO is also our president, just by the way. Yes. Yeah.
From a general sort of permitting, government approvals, ESG sort of perspective, what are you seeing, particularly in gold, but in the current sort of environment? Is that a real risk, you know, moving forward? And, you know, what's your take on the current climate and how we can, I guess, AMEC, and how we can better address, you know, mitigating that risk?
Sure. Look, it's not getting any easier to get a project permitted at the moment, unfortunately. So we're really focusing on those duplications. The big issues coming upon us are the nature reform legislation. So federally, it's really the environmental, and that's really our biggest problem. So what we try to do, or we ensure that any legislation that is proposed, we have input into it, we give that to all of our members, get their feedback, and take that back.
Excuse me.
Sorry.
Sorry. Apologies.
So that we can get legislation improved for the industry before it's released. And so we really make sure that we get to have input into that legislation. So I think, to be honest, the environmental reforms that have been proposed could cause a lot of issues for people, and I think the concerns that have arisen from the recent Regis decision add to those concerns.
And is it similar from a exploration perspective as well? You know, there's obviously a bunch of stuff.
I think it's a little bit different. So our explorers just need to get on the ground. That's really their biggest issue. They need land access. And so for them, it's really all about getting on the ground and doing their drilling projects. So we've done a lot of work around that side of things and making sure that there's easy, accessible agreements and communications open, et cetera, et cetera. One of the problems we're experiencing at the moment, particularly in New South Wales, is the interaction between the explorers and the renewable energy proponents. The renewable energy proponents don't seem to have been held to the same standards as the mining community so far. So actually AMEC's just about to do a big submission on that exact topic and how the renewable energy proponents are impacting the regional communities with their projects. So what we've found extensively, and we're working hard on this in New South Wales with the different ministers, is that, for example, an EL holder has made an agreement with a landowner and they have access to the land, and then along comes the renewable energy proponent who's also made an agreement with the landowner but hasn't communicated. No one's communicated to the EL holder, the exploratory licence holder, and just turns up one day. And so there's a big dispute. We're having wind turbines erected over areas that explorers did want to drill under, and quarantining areas of land. So we're working hard on that issue at the moment, and we're making good ground.
Okay.
Yeah.
Thanks, Kerry. I guess one of the last questions before we close, COVID, you know, it knocked us around a fair bit and a bunch of things changed and some resemblance of normalcy is getting back. I guess opening it to the panel, is there anything in particular we've seen as a result of COVID that is still prevalent and affecting us today, whether it's project delivery or from a financing perspective, and do you see things sort of, how do you see that moving forward, any of the changes that COVID has brought, you know, whether it's logistics or whether it's, you know, from a financing perspective?
Yeah, I can put the project delivery spin on it, Reuben. Obviously, post-COVID, we've seen labour costs increase quite a lot, which has made building these projects a lot more difficult. Through COVID, you mentioned logistics. Obviously, shipping was quite a challenge during COVID. We saw shipping costs, freight increase quite drastically, almost by 50% through COVID. It's come down, not quite back to where it was. It's maybe still about 10-15% above where it was, but it is still a little bit high. We did see steel and say copper cable, just purely due to a cut in supply. The costs of all of these commodities increased. They haven't come back to where they were. So a lot of electrical equipment, a lot of structural steel is still quite still more expensive than it was pre-COVID, and delivery times for electrical gear is still through the roof. So that's a challenge that we've been having to navigate in the project delivery sector.
So Reuben, our members reported that during COVID, because Australia was open for mining and open for business, that a lot of investment came into the country, and that post-COVID our members have advised that investment has returned offshore in part. So that's an interesting post-COVID comment. Yeah. Mm-hmm.
I think COVID in production has left an indelible mark on management teams, because you look at your production statistics and you say, same amount of tonnage, 30% less staff. Now, how are we going to explain this to the shareholders?
Yeah.
Right? You got too many toys? You got too many people? That sort of stuff. So, we didn't really get affected. Supply was a problem. Mm-hmm. It's coming good now, but only now. And cost is through the roof. Cost is just through the roof. Costs always follow revenue, right? They're really sticky. Mm-hmm. So we saw that huge uptick in costs, and on a practical level, you need to build out your store, your store of all sorts of goods that you just couldn't get delivery of, delayed delivery.
And I think, Reuben, too, that might have, I'm sorry to interrupt, I think that might have led to the government's Future Made in Australia policy, which has given a lot of incentives for the critical mineral industry going forward, and really made us realise that we need to become independent. It's
great, but nothing will ever happen, because it never does. When you're talking about regulatory, I'm thinking, is this the time to put in an appropriate groan? Because regulatory is a nightmare, still is, but lots of promises to fix things and change things. Nothing ever happens, which is great. Thank you. So what's happened in the various state bodies is they've all been amalgamated. The mines departments don't exist anymore, so pick a state, New South Wales, pick Victoria. It's nestled nicely in the same portfolio as forestry and climate action. Go figure that one. I don't know about that. They've never had enough funding. There's been a gradual leakage of skill and experience within the bureaucracy out, either through retirement or through the consultancies. So you've got a bunch of junior bureaucrats, first, second, third year out of university, who see these sorts of positions as a stepping stone to the next promotion. So they don't really hang around long enough to get any experience. And when you're trying to get permitting through, what generally happens is they'll put it off to the last day, then send you a question, you get a reset for 90 days. This can go on. We just had one RL converted. It took 2.5 years. In the end, when they got to it, it took 2 weeks. Right, so it becomes frustrating, and so the problem, that is always going to be a barrier to development in this country, always. and it needs to be addressed at the regulatory and the government level, because there's nothing we can do about it. We can't assist them, we can't help them, and all they do with their inexperience generally is they rely on the legislation. They just go back and read the legislation word for word and say, well, that's what you've got to do. There's no grounds for them coming and having a look, looking at the team, look at what's going on. Yeah, look, that's a risk that's acceptable. We don't see that anymore. That's sort of disappeared. So the action really is on the various state government regulatory authorities, to find the money to fix it. There's not a lot of money, but it just needs fixed, and to try and suck some experience back into the departments. Tasmania's a good one. I've done quite a lot of work with Tasmania. They're actually very helpful. They ring you up and want to know what's going on, and can we introduce you to ministers, and there's money available here for infrastructure support. And every time they do that, I sort of fall off the chair saying, is it the 1st of April or what's going on here? We've had 6 ministers in Victoria in 7 years. I've never met one of them. We've had 4 heads of the mining department. I've only met one, and he didn't last long. He was pretty good actually, but the bureaucracy soon found a way to get him out because he was too good at his job. But you just don't get any interaction. And on the explorers, it's all about community. It is only about community for explorers. If you've got a good relationship with your community, good support, you won't have a problem with land access. If you can get 80 to 90% of your EL access, that's a pretty good outcome. You're always going to have someone who hates your mine or someone who hates a drill rig. Okay, everyone's got one of those. Every operation or every explorer's got one of those. But, so we invest heavily, our operations invest heavily in the community side of things. And it's not just about, supporting the local football club and all that sort of stuff, and the netball team, which is important, but it's also about keeping the community informed and engaged. We have a couple of environmental committees of 7 people on these operations. 6 of them are elected from the community, and one from the operation, just so they can bring the facts in. So that seems to be the biggest help, but the biggest issue.
Thanks, Campbell. And Kerry, anything you wanted to add? I guess
no,
you're
everything
involved.
Campbell just said, but we're working hard relentlessly on it. We won't give up. And that's what AMEC does day in and day out.
I was going to say that's part of what
Yep,
you guys do on a daily basis. So lots to do.
That's great to have been in operations and have that experience of having the rejections and all the other problems. Yeah.
All right, we're out of time, but I think one more comment, John. And
just one quick one.
Close out.
The other thing which makes life harder for the industry every day is increasing, let's call it resource nationalism, increasing taxation of the resources industry everywhere around the world. And it's inevitable because we are seen as a milking cow.
No worries. Well, apologies. We've run out of time for any questions, but our panelists will be around if you want to reach out and have a chat to them. So with that, thank you very much
Thanks,
to the
Reuben.
team here.
Thank you.
Thank you.